Hello, everybody, and welcome to our next discussion on auditing. Specifically, this is the topic of materiality and the audit risk model. So, first of all, let's talk about audit risk. What are we concerned with while we're performing an audit on whether it be a set of financial statements, a cost report, an income tax return, whatever it might be. Specifically here, we're dealing with the financial statements. So the audit risk we're concerned with is the risk of material misstatement being allowed in the finalized financial statements. In other words, what risk do we have that after our audit, there is still going to be a material misstatement that made it through to the end financial statements? The provider or company, client didn't catch it. We didn't catch it as an auditor. The controls didn't catch it. It made it all the way through the financial statements. That is overall audit risk. But the key thing, we have a couple of words here, or one word specifically, material misstatement. So again, we're not necessarily concerned with every single thing being perfect. We're concerned with the risk that a material misstatement made it through to the finalized financial statements. So material. We're not talking about materials for a product. We're talking about the idea or the concept of materiality. Does the issue, does the risk matter? Does the item matter? Does the error matter? So the idea of materiality is defined in FASB Statement 2, and it's defined as the magnitude of an omission or misstatement of accounting information that, in light of surrounding circumstances, makes it probable that the judgment of a reasonable person relying on that information would have been changed or influenced by the omission or misstatement. Now that's a fairly long sentence there. The way I like to sum it up is we're looking at that mistake, and in hindsight, we're trying to identify whether that was a big enough mistake that the truth would, if it was known, if the truth was known or if the accurate information was known, it would have changed somebody's decision. Just a quick example. If we allow an error for inventory to go through, and maybe it was a transposition, just some little error, and we find out that the inventory was overstated by $10. We're talking $10, 10. That's an error, certainly. If we knew it after the fact, if somehow we were able to later go back and find that, oh, that inventory shouldn't have been $10,000, it should have been $999, $99,990. So there's a $10 error. But the point is, it's one of those things like, who cares? That mistake is not big enough to change really anybody's mind. And I guess I really don't care how big of a company that is, how small of a company is. It's hard to think that $10 would change anybody's mind for inventory, for an asset. Now, if that was 1,000, maybe depending on the size of the company, that might be material. Maybe it might not be. If it's a really large company, $1,000 may not be that big of a percentage change, and it may not change anybody's mind. But obviously, the larger you get with those errors, it's much more likely to be considered material. So there's not some sort of bright line threshold where something becomes material. You have to consider a lot of different things. You have to consider that size of that company, what the investors or users of those financial statements need. So there are a lot of things that comes into play. But the idea of materiality is very important. It's just how big or how important is that mistake. Would it have changed somebody's mind if we had found the mistake and corrected it? Would that have changed somebody's mind? So that's what to think about with materiality. So now let's discuss that with the audit and with the idea of risk. As an auditor, our responsibility is to provide a reasonable assurance. So that's the first phrase we want to look at. Reasonable assurance, not a guarantee, not absolute assurance. We're trying to provide reasonable assurance as to whether the financial statements contain any material misstatements. So again, it's not a guarantee, it's reasonable assurance, and we're not even providing any assurance at all that every single misstatement was corrected. It's just those that we believe would be material. So we're looking for the bigger errors that we think would change somebody's mind. So that's what I have for these two limiting factors. Reasonable assurance, it's not a guarantee. And material misstatements, we're not looking for every single small mistake, just those that really matter. Now, it's our estimation as auditors what we think material is. Another auditor or another client, another user of those financial statements might have a slightly different decision, but that's our responsibility to determine materiality. And we'd have to defend that if that was ever challenged in a court type situation. That would be our responsibility to defend. Now, the reason for these limitations, you might think, hey, if we're doing this review, why don't we just try to get perfection? And the answer is that the cost of that perfection far outweighs the extra benefit. So we're talking from an incremental type perspective here. Incremental meaning every little additional amount. So let's say we do a review and we find 80% of the mistakes. That's going to cost us X number of hours, X number of dollars to find that 80% of mistakes. Now let's say we want to try to find another 10% of all those mistakes. That extra 10% is going to be more costly than, let's say, the 70 to 80 percentage would have been, that 10%. The closer you get to perfection, the cost of that incremental accuracy, if you will, increases by quite a bit. I wouldn't necessarily say exponentially, but it increases at an accelerating rate. So for that reason, we have to find that sweet spot, that happy medium where we believe we have enough accurate data without taking 2 years to do the audit. And I'm exaggerating a bit, but if you wanted some perfect, absolutely guaranteed set of financial statements, it would take much longer than the 2 to 3 months that auditors have currently to audit a set of financial statements before it goes over to the SEC. Now, the same thing holds true for most audits. When you start getting into forensic or fraud type audits, then you're much more concerned about some of these things, so you spend more time with it. You're willing to because you believe something exists already in error. With a set of financial statements, we don't know for sure whether there are any errors. We want to be skeptical, but there's nothing pointing us to an error right off the bat. So again, materiality, that depends on the company, the auditor, and its user. Preliminary judgment, as we're deciding whether to engage in this audit and as we're preparing for the audit, we have to plan for it, and we use our judgment to set the materiality thresholds. Now, there might be situations where after we've gone through the audit part way, now we have found some things that is changing our preliminary assessment, so we may revise that. We may revise our determination of materiality. We might have to consider our budget and adjust our materiality threshold based on that. And once you identify a total, what's called a tolerable misstatement, it's the amount of error you're willing to leave on the table, so to speak. You're not going to spend the extra time to look at it. So once you find that amount of tolerable misstatement at the big picture level, the entire financial statement level, the idea here is you assign it to each unit. That could be each asset, each group of assets, each group of expenses, each group of revenues. You want to spread it out because then the idea here is whoever's auditing accounts receivable, for example, we're willing to allow a certain amount of tolerable misstatement. That tolerable misstatement, the more we allow as a misstatement, the less risk we have that we're not finding those other misstatements. And we'll see that in just a little bit with detection risk. Now, of course, this is all somewhat big picture at this point because we don't know what the total error is. We have no way of knowing that until after we've done as much review as we can. So we're just predicting into the future based on what we know about this company, what we know about auditing certain things in general, certain industries, certain assets. We know what we believe some mistakes may be. Some of them are known, and some of them are just likely. So we're going to take a look at that and try to do our best to plan for this. Now we're going to move into something called the audit risk model. So we have our idea of materiality. We've talked about tolerable misstatement, just that concept that we're willing to allow some error to stay on the table because we don't have the time or budget to spend to get it 100% accurate. We just don't. So the idea here is risk. What risk do we think exists in this company just based on our assessment as an auditor? So this audit risk model has three components, and there are a few different ways of looking at this. I'm going to show you both of them. But the audit risk model has three components. The inherent risk, I'm going to talk about each one individually. The inherent risk multiplied by the control risk multiplied by the detection risk. Those three items multiplied together give us the overall audit risk for this company. Now the thing here, we're multiplying something, so that kind of implies that, hey, is this a perfect number? Do we know what this number is? And the answer is generally not. It's our assessment. We have no way of knowing it 100%. We can assign this as very generic terms like high, medium, or low. We could say, hey, our inherent risk is high, but our control risk is low, and our detection risk, therefore, has to be medium. Or you can quantify it by a percentage. Maybe you'll rank it 1 to 10. Maybe you'll rank it percentage-wise. There's 8% risk here, 52% risk here. So there are a variety of ways to do it. And how you do it's going to depend a lot on what audit firm you go to, what audit programs you use, just the way things are done in that particular industry, in that particular firm. So, again, we have those three things we're somehow going to multiply together to get an estimate of what we think the risk is. Now, another way of looking at this, down here in the middle, audit risk equals detection risk times inherent risk times control risk. By the way, we're multiplying those three, so it doesn't really matter what order they're in. We can take the inherent risk and the control risk together, and we're going to see that that's basically our risk of material misstatement. Now, this will make a little bit more sense, and I'll come back to this after we've defined these three. But the risk of material misstatement, that means that there is an error that existed in the financial statements, so the management or the accountants made a mistake, and the controls did not find it. Their own internal controls didn't find it. Therefore, the material misstatement exists by the time we as auditors are getting to look at these financial statements. So if we're concerned about what risk do we have that we won't detect it. If a material misstatement exists, we need to find it. That's the hope, that we find it. The risk is that we don't. The detection risk is the idea that we may not find that material misstatement, and it may make it all the way to the financial statements. So audit risk is the risk that the error exists to begin with, material misstatement, multiplied by the risk that we don't find it. So again, risk of material misstatement is the inherent risk multiplied by the control risk. Now again, we can assess those as high, medium, or low. So now we're going to spend a little bit of time talking about those three risks before we go too much further. So the inherent risk, that idea, is the risk that the company's accountants, or perhaps their systems, management, so whoever's working on that company's financial statements, it's the risk that they've made a mistake, whether it was intentionally, which would be more like fraud potentially, or it could just have been an unintentional error. There are a lot of things that lead to this risk. We'll talk about those in later discussions. But for right now, we're just saying there's the risk that mistakes were made. Now, there are a few things that give rise to these inherent risks. The expertise of the accountants that are working in your company. How well do they know the industry? How well do they know the books? How well do they know the systems? Are they competent to do the job? If they're competent, this reduces the risk. If they are new, if you keep turning over accounting staff, or if you just don't hire skilled accountants, this raises the risk. The complexity of the environment or the industry, obviously the more complex it is, certain industries are just by nature more complex than others, accounting-wise. So the more complex it is, the larger the company sometimes, that leads you to higher inherent risk. And the quality of the documentation that exists in that company, that also could lead to inherent risk as well. So that's inherent risk. Then we have control risk. So this is the idea that we already had the inherent risk. The risk already exists that some error was there. The control risk is the risk that we have an internal control system that's not strong enough to catch those likely errors. So the better the internal control system, the stronger it is, the lower this risk will be. Because if we can trust the system to catch things, then the risk is low. On the other hand, if the company has few or no controls to begin with, then there's a higher risk, obviously. So we assess the control risk in part by testing the internal controls. We take a look at them, we review the documentation, we test it, and then that gives us an idea what the control risk is. Then we have detection risk. So the first two risks that we talked about, inherent risk and control risk, there's nothing we can do about them. We have to live within that risk, but we need to assess it. On the other hand, detection risk, that's the only one that we can actually control as auditors, because this means whatever this risk is, we can reduce it by simply doing more work. We can spend more hours on the audit. We can adjust what's called the nature, extent, and timing of our substantive procedures. And what that basically means is change what types of procedures we do. The extent is more like the depth of those procedures. When we get into sampling later on, we'll talk about maybe we're just going to sample 10 units out of 150 units. We're just going to look at 10 of them to get an idea about what we'd find in the entire 150. To adjust the extent of that testing, maybe we'll double it. Maybe we're going to do 20 or 25 or 30 to get a deeper extent. And then the timing, nature, extent, and timing. We talk more about this in later lectures as well, but the timing, one example might be inventory, for example. Instead of waiting until the end of the year to do the inventory test or watch the client do the inventory test as an auditor, we're an auditor. Instead of waiting until the end of the year, maybe we want to visit the provider site, the client site, throughout the year and watch as management or as the accountants do the inventory on a monthly basis or quarterly basis. So that's changing the timing of those procedures. So again, all of that nature, extent, and timing is discussed in a later lecture, but the reason I'm bringing it up is that's how we adjust detection risk. Right now, we're just trying to figure out, based on what we want the audit risk to be, what we want to get it down to, we have to take a look at what we've already identified the inherent and control risks to be. And that basically, as we'll see in the next slide, that tells us what the detection risk has to be reduced to. For example, if we have a very high inherent risk and a very high control risk, we have to get detection risk to a very low amount. The risk is very high that error still exists and wasn't caught by the client, so we have to make sure our risk is low that we don't catch it. To do that, we have to do a lot of extra work. So again, now we're looking at detection risk. I'm going to come back to this in a few slides because we're going to go back and talk about how to identify what we need to get this risk down to, and then we'll break this risk down further. So as I said earlier, we have to identify what we need to get that detection risk down to, because understanding what we have to get it down to is going to help us identify what level of work do we need to do. So to get planned detection risk, or what we want to get the detection risk down to, the way we do that is we take a look at that audit risk, that acceptable audit risk, what we are allowed to have audit risk at. In other words, what risk are we willing to live with that an error was just flat out not found? So what is the acceptable audit risk? We're going to divide that by inherent risk times control risk. Those are the risks. Remember, we called them the risk of material misstatement. Those are the risks that the error exists and was not caught by the internal controls. So take acceptable audit risk divided by that risk of material misstatement. That tells us what we have to have our planned detection risk at. Again, you can quantify it. Obviously, it's quantification, whether it be a scale of 1 to 10 or a percentage. That's the only way you're going to really be able to divide anything. You can't divide phrases. So you can't say low, medium, and high. Low divided by high equals what? You can't do it. It's not logical. You can get some abstract idea, but if you really want to get a quantitative factor, you need to start out with quantitative risk assessment. So that's what we have here. Now again, acceptable audit risk we just talked about. That's what we're willing to live with. But remember, it doesn't have to be zero. We're not trying to get audit risk down to zero because we're trying to provide assurance, reasonable assurance. So the point here is what are we defining reasonable to be? If we want a high level of reasonable assurance, for whatever reason, maybe our investors are really concerned, or investors or even users of the financial statement, maybe it's a bank that's hiring us to do this audit. So if they're really concerned about this and they want near perfection for these financial statements, then our audit assurance is at a higher level. The higher that gets, generally the more work we're going to have to do. So that's the idea behind it. But the point is, audit risk, acceptable audit risk, is very closely related to the concept of audit assurance. They go hand in hand. You have to know what level of assurance you're supposed to have before you can determine the acceptable audit risk. So what I was getting at there, again, we're taking a look at a few things. We do take a look at external users, whether that's the investors, whether it's a bank, whether it's a government entity. But we also look internally at the concept of engagement risk. We as an auditing firm, as a company, put our reputation on the line when we're doing these financial statements, when we're signing off on a set of financial statements. So the question is, what is the risk of this engagement? If we have taken this engagement on, what is the risk that this is somehow going to come back and bite us later on? Now, if there's a company that has a history of fraud, for example, then there's a risk that we're associating our company with this fraudulent company, and that may affect our reputation going forward. A great example of this is back from around 2001 or so. We had a variety of firms, Enron and some other firms. All of this led to the Sarbanes-Oxley Act legislation, but we had some firms. Enron was the prime example. They were audited by a firm, one of the biggest accounting firms in the world, one of the big five at the time. It was known as Arthur Andersen. It was, previously a very reputable company. It's had a long history, but they got associated with this company, and nobody's saying they were involved in the fraud per se that went on with Enron, but the accusation was that they didn't do enough to catch it and mitigate it and find it. They didn't do a high enough quality audit to correct for those risks. So that's the idea of engagement risk. To Arthur Andersen, the engagement risk of taking on Enron was that their name would be soiled as well, and in fact it was. Arthur Andersen, in its original form, is no longer an accounting firm. So that's the engagement risk. That's the concept of that. The other thing we need to look at is the degree of reliance by external users. Is this an important set of financial statements that a lot of other people are going to be relying on to make decisions? If it is, then there's a risk that if we miss something and these other users make bad decisions based on that faulty data we gave them, they may come and sue the audit firm. They may say you didn't do a high enough quality work. That's exactly what happened with Arthur Andersen, by the way. So, again, the degree of reliance by external users, the likelihood of client difficulties after the audit report issuance. So, again, is this company nearing bankruptcy? Are they about to go out of business? And if so, that's a risk because we're going to be involved with them. If they go bankrupt, the investors lose money. There's a concern there. But the other thing that leads to this risk is the auditor's evaluation of management's integrity. We want to make sure at the very least that management themselves, the top executives, the audit committee, they're ethical, they have high integrity, the tone at the top, that's the term often used, the tone at the top is that of integrity. If we can at least trust that that is instilled at the top level, then that certainly reduces the risk downstream. But if at the very top level you have bad integrity issues, you have bad ethics, then there's a much higher risk that that stuff's going to flow right down and that there are going to be errors that are trying to be hidden. So that's the idea there. So now I'm going back to detection risk. We said that detection risk is the one risk that auditors can control. We're just assessing inherent and control risk. But let's break down detection risk a little bit. There are two things. There are two components of this. There's first of all auditor error. This is the error that auditor has just flat out done something wrong in their testing. They misapplied a test. They misinterpreted the results. Or they misapplied the sample. And we'll talk more about sampling certainly in a later discussion. But the idea here is that this auditor error, we can correct for this. We can control this by providing more training to the auditors, doing a better job planning, and staffing an audit with those that understand audit in general of that industry, and certainly supervision, reviewing the auditor's work. That allows us to correct for potential auditor error, or at least reduce the risk that auditor error will exist. Now, sampling risk is something completely different. This is the idea that we're not going to review 100% of every unit that we test. We're going to review a small sample of it to get an idea about what errors we think will exist. So the idea of sampling risk is the fact that our conclusion as an auditor, based on the review of this one sample of, let's say, 10% of the units, our conclusion based on that sample review might be different than what we as an auditor would have concluded if we had spent the time to review 100% of the population. Now, the reason that would happen is that our sample was not really representative of the entire population to begin with. So our small sample we reviewed, maybe we didn't find any errors, but maybe there were a bunch of errors in the rest of the population. Our sample just wasn't really a good sample. There are ways to correct for this, and we'll talk more about this in the sampling lectures. Now, there are two different risks that when we get into sampling we'll talk more about. It's called type 1 versus type 2. Type 1 is the risk of incorrect rejection. In other words, we find something to be an error when it really wasn't. So we think the financial statements have a lot of errors, but in reality, there were just a couple in that sample, and really there weren't any more in the rest of the population. We just didn't know it at the time. That's type 1 risk. Type 2 risk, well, let's go back to type 1 risk. The biggest concern with type 1 risk is that we're going to believe there are a lot of errors, so we're going to make a lot of corrections that really didn't need to be made. They weren't truly a bunch of errors throughout the rest of the population. Type 2 risk is the risk of incorrect acceptance. This means we missed something. We didn't find any errors in the sample, so we presumed that there weren't any errors in the rest of the population. So we accepted it without correction, but the problem is maybe there were a lot of errors in the rest of the population. We just didn't happen to pick any in our sample. That's the risk. So that really starts us into our discussion later on for sampling risk. We're not getting there quite yet, but that's another lecture. Hopefully this lecture has helped to talk about the concepts of materiality and audit risk overall. There's still plenty to talk about, but this is a good introduction to it. So hopefully this has helped. I thank you for your time, and I'll see you in the next lecture.